This is a presentation on Adore Beauty, where I'm going to propose to you my, valuation analysis in this presentation. These are the contents that I'm going to cover today, from the current situation and also the competitive edge of the company moving forward with, the growth trajectory of the company, and also provide you some downside factors that is going to impact you as an investor investing in the company, and also for the company moving forward into the future in the industry. Finally, when we package everything up and also providing you the valuation, I will give you my proposition to see whether you should invest in the stock or not. This is an overview and a simplified overview of what I'm going to talk about in the following slides. Key takeaway here is that the company is a market leader in the industry with 11% of market share, high growth potential moving forward into the future because of the acceleration of e-commerce adoption by customers. However, it faces very strong competition from multiple directions because of the low barriers to entry and also the nature of the industry itself. So the current situation here. Adore Beauty was established back in 2000, and it is now the leading pure play online beauty retailer in Australia. It offers a broad range of beauty and personal care products ranging from 260 brands and 10,800 products. In 2019, the company founders sold a majority stake to Quadrant Private Equity Group, and subsequently the private equity brought the company public on the Australian Stock Exchange in 2020. Currently, the company has a market capitalization of $390 million with no debt, and most of its earnings comes domestically in Australia. To give you an idea about the business structure of the company, we have to talk about the supply chain of the company. So first off, Adore Beauty established a basic or exclusive contracts with its supplier, and it will buy or purchase the products from its suppliers and stock it into its warehouse. Customers will then make online purchase through App Store or website, and then the Adore Beauty will receive the orders and start pick and pack all of the orders and ship it out to a courier agent for the delivery. The courier agent will deliver the products to the customer's address at a designated time period. Looking at the warehouse right here, the warehouse is stationed close to the Melbourne airport. That means it's more efficient for the delivery and faster when it is trying to ship it out internationally or domestically with different states, like in New South Wales and also in South Australia. Currently, it has a utilization rate of 31%, and it has the capacity to support more than triple its current utilization rate, or the daily order from customers. What does that mean, you might ask? Well, the company does not face significant constraint from the workload or the efficiency from or the warehouse efficiency when the orders increases. That means less blockade and also less constraint moving forward into the future when more orders are taken by the customers. The inventory here is to show you again, offering 260 brands and 10,800 products with inventory turnover ratio and also the days of inventory held on hand tracking closely with its peers, which is, it's a positive sign for the company. Now let's dive deeper into the revenue drivers right here. First off, let's look at the active customers on the left-hand side column. We can see that the active customers over the past 4 years have been increasing significantly, at that period with high retention ratio averaging more than 50%. What does that mean? Well, that means customers are staying loyal to the company and purchasing more frequently from the company. And we can see the same picture here again on the right-hand side. The column right here shows the annual revenue per active customers. And we can see it's increasing, although at a slower pace, it is still increasing over the past 3 years from, in 2020, $206 all the way up to $219 in 2021. All is well, all is good for the company. So now let's look deeper into what are the differentiation or what are the competitive edge that the company has that has kept the customers loyal to the company, has kept the customers loyal to Adore Beauty. What are the differentiation, you might ask? Well, the first case here is that the company has the best shipping policy out there relative to its peers. You might ask why? Well, the company has adopted or assigned Go People as its major courier service or the courier agent in New South Wales and also in Victoria. It is faster, more reliable, and more efficient than the traditional courier services like the Australian Post, which is not as good as the Go People, I would say. The second factor here on the shipping policy is because it provides the best cost saving to the customers. What's not to like for the customers when they can save more from buying in through Adore Beauty's website relative to like Sephora, Myers, or Mecca. It's all good for the customers, and also because more spending are done through the Adore Beauty website, more revenue will be generated throughout the whole year moving forward for the company. It's all good for the company, a win-win situation for both the company and also for the customer. The second, competitive edge that the company has over its peers, it's high organic search in the website traffic. Over the past 2 years. In 2020, different channels of website traffic, especially for the organic search, takes up only 37% out of all of the other channels. And that number had increased up to 60% in 2021. You might ask, what does that mean? High organic search. What do I need? High organic search. You know why that's important? It's important because customers are taking the initiative and are proactively searching out Adore Beauty website, and they're only one step away from making the real transaction and translating searches into sales for Adore Beauty, which is a good thing. Same picture here for the website users on the right-hand side column here. Over the past 5 years, website users have been increasing significantly with 52% CAGR, standing at 25 million users in 2021. All is well, all is good for the company, and it is a win-win situation for the customers and also for the company. It's all positive things, isn't it? Talking about the upside, talking about the competitive edge of the company, and now we will move forward to talk about the upside of the company, the growth trajectory of the company, where it's going moving forward into the future in the industry. There's a survey conducted by Frost and Sullivan, a research firm internationally, where they asked the frequency of Australian different age group cohorts in Australia to see their frequency of buying beauty and personal care products over the past year. We can see that the age group between 18 all the way up to 44 years old are the one most likely to spend more on beauty and personal care products. The similar story, coincidentally, you can say that at the same picture right here, that the Australian age group for the age 25 to 34 cohorts are the second largest population in Australia. What does that have to do with adore beauty? Well, we know for a fact that the younger they are, the younger age group they are, customers are going to spend more on personal care. Therefore, Adore Beauty has to capitalize on the young age group cohort to compel them, incentivize them to spend more in the Adore Beauty website or the App Store. From there, they can Adore Beauty can translate those searches, like I said, a lot of searches in the website and also in the App Store, and translate it to the sales. Capitalizing on young age group cohort, incentivize them to buy more, resulting in more revenue growth moving forward into the future. The second growth factor here is about the e-commerce adoption by customers. Over the past 3 years, Adore Beauty has invested significantly on the social contents, ranging from the podcast, blog post, YouTube channel, and don't forget, the social media channel also plays a huge part in driving young age group cohort to make that transaction, incentivize them, compel them to buy more. All of that is done, of the social media channel, of the marketing, the marketing strategy is done to incorporate it with its App Store to provide a seamless e-commerce experience for the customers. A better, a more strategic way of translating searches into sales, because this is the future. This is the future is because we can see directly on the right-hand side, the picture here shows that the mobile commerce done in the App Store is more than double that of the mobile commerce done on the browser. What does that mean? You might ask, that means Adore Beauty has to capitalize or has to focus on the in-app store purchase experience for the customers, so that it can translate those searches and also translate those views from social media channels into sales, providing a seamless e-commerce experience again for the customers. You might say that, what? Adore Beauty had only registered 1 million revenue through the through the in-app store platform, as opposed to the website. This is a risk. This is not the platform that the company should focus on. I would say, what? It takes time. It takes time for the company to invest significantly on the social media channel and also the App Store to provide a better experience for customers, so that it will incentivize them from transitioning away from the website all the way to the App Store. All is well, all is good for the company. Good, great competitive edge, good growth trajectory, or the story behind it. We will now talk about the valuation of the company. Good, great stories right here. So what's the intrinsic value? How much can we gain from investing right now? What are the upside benefit that investors like you can gain from investing right here, right now, today? I have adopted 4 key metrics with more weights on forward-looking metrics like discounted cash flow valuation and also the broker's target. and less weights on, backward looking metrics like past year trading price and also comparable multiples. We can see that, the current share price as of 14th of December, just yesterday in 2021, stands at $4.12. It's less than the intrinsic value of $5.48. What does that mean? You might ask. Well, clearly the company is undervalued right here. It has a margin of safety of more than 30%. And, does that mean that that investors like you should start investing right now because it's undervalued? I would say, hold on a minute. Hold on a minute. We need to talk about the risk factor that you as an investor is going to face when you invest in the company as a shareholder of the company, and also specifically that the company is going to face, the risk factor that the company is going to face moving forward into the future. The downside factor right here. What are the downside factor? You might think, we've been talking so great about a company, great competitive edge, good, growth stories moving forward into the future. What could go wrong? I would say, many things could go wrong right here. And we can do that or, illustrate that by using a very simple metrics, the Porter's 5 forces, a very fundamental metrics to gauge or to evaluate where a company stands in the industry. First off, let's look at the first metrics, the first force or the first forces right here. The threats of, substitution, high. Rating is high. You might think, why? Well, you know what? Customers can make, can shop online, offline seamlessly without having to experience significant constraint. Without online purchases or, online e-commerce, customers can just walk or, drive 5 to 10 minutes away from the closest retail mall and buy their preferred beauty products easily, without, significant constraint. Therefore, the threats of substitution here is very high. Next, we'll look at the threats of new entrants. Again, the rating here is high. Why? The industry itself has a very low barriers to entry. This means that, competitors or new entrants can just come in and disrupt the whole industry by doing, some arbitrary activities that is going to take market share away from adult beauty. Take for example, a new entrant come in and they can just easily set up a social media account for their marketing strategy and also establish a website for customers to make transaction. And for example, the new entrant can just price any products lower than adult beauty. What does that, what will happen? Customers will easily shift to the new, entrant, to the new competitor, and divert away from buying in adult beauty website. So the threats here, the competition between new entrants here is very high. And the story does not get better. The threats of existing competition, again, it's high. You might think, why? The company has great competitive edge. Why does that, why? I thought, the competitive edge is going to shield the adult beauty away from its existing competitor like Mecca and also Sephora. Well, you know what? The competitive edge that we've been talking about, the best shipping policy out there for the adult beauty, it can, competitors can easily adopt the same policy, and customers will then start shifting away from adult beauty because maybe their preferred channel is through Mecca or through Sephora. So the competition here is very high. the competitive edge is highly or easily exploitable by existing competitors. It does not even help because of the highly fragmented market in the industry, where there are no clear market leader in the industry. You can say that, you know, Adore Beauty is the leading has the highest market share, you know, 11%, and it has the pricing power. That's not true. We can see that again, you know, customers can shift away from offline to offline, online to offline, and also can shift from platforms to platforms. Adore Beauty does not have pricing power. They don't have pricing power at all. Nothing. And just by looking at these three key forces, Porter's forces, we can see that the slide shout competition, competition, competition. It's not going good for the company, isn't it? We have not finished this whole, you know, analysis on the Porter's 5 forces. We will now look at the supplier bargaining power. Rating is medium. I would say even high, but, you know, let's just say it's medium. Why? Why is that the case? To give you an idea, we need to talk about, you know, Adore Beauty's supplier. Let's take, for example, Estee Lauder, highly reputable company, international recognizable brand, you know, very famous beauty products. If, you know, Adore Beauty buys Estee Lauder's products, but you know what? Adore Beauty is actually competing with Estee Lauder for sales. Think about it. You can, you know, buy from Adore Beauty, and also Estee Lauder has their own website and also have their own brick and mortar stores. So Adore Beauty is competing with its supplier also. And don't forget about, you know, the traditional competitors, the offline competitors, like, you know, the retail stores, and that's the third competitor. Technically, Adore Beauty is facing a three-way competition across the industry, and the irony here is that the company is competing for sales with its supplier, which is, you know, it's just ridiculous right here. So it does not have strong bargaining power against the supplier here. Supplier can just sell it through their website without, you know, the help of Adore Beauty to sell it online. A bad news. Lastly, let's talk about the customer's bargaining power. Rating medium. Why is that the case? You know what? We've talked about, you know, high competition. That means there are a lot of, you know, platforms that customers can enter to, can make transaction. Therefore, customers will always find the most, you know, valuable, find the most cheapest, let's just say, the cheapest and most value to money for them to make the purchase for their preferred beauty products. That means customers' demand are highly elastic right here. Adore Beauty does not have pricing power against the customers right here. Don't talk about customers right here. They don't even have pricing power against the supplier right here. One thing to know, one thing to note right here on the customer bargaining power is that, you know, technically customers are loyal to the beauty products that they purchase, not Adore Beauty itself. So the customers are actually loyal to the product that they want, but not the company, like, you know, Adore Beauty itself, which is a bad sign for the company, because in any cases, customers will only view the value that it provides through the lens of the products, but not the services provided by Adore Beauty. Highly elastic demand, low pricing power against customers and also against suppliers. The slide shouts competition all the way through. It's a bad news for Adore Beauty. Nothing seems to be working well right now, despite, you know, all of the benefits we've been talking about in the past few slides. To dive deeper into the risk factor right here, we will need to talk about, what incentivizes shareholders to invest in the company. Well, of course, shareholders would want, high EBIT margin of a company because, have pricing power and also have dividend policy that can reward shareholders for owning the stock. That's not the case in Adore Beauty. It does not have dividend policy. And also, if you look at the annual report right here, it says that very clearly in 2021 that it's going to expect to maintain a very low EBITDA margin moving forward into the short to medium term future. What happened? I have no idea. Maybe they are trying to reinvest all of the earnings for marketing strategy, or trying to capture more customers through different marketing initiatives. No idea. But we can see clearly that the EBIT margin over the past 3 years has been very high. 8 to 10%. It's very high. It's good. But what happened? 3% in 2021. The marketing expenditure was almost this. It did increase by a substantial amount, but that's not enough to justify the deep decrease in the EBIT margin in this year in 2021. Nothing seems to be right. It does not reward shareholders through dividend policy, and it does not have pricing power or high margin that can shield investors away from competitors, where investors are more likely to invest in the good company with high earnings growth or high earnings margin. That's not the case in Adore Beauty. And one of the risks here, another risk that I would say that although I do not know what will happen, what's the implication, I have no idea, but it's good to think about. Is that what about the exit of the private equity group? We know for a fact that Quadrant Private Equity, the group itself, is going to exit. Sooner or later, they will have to exit because they have to reward or pay back its limited partners. Therefore, what's the implication here? Is it a risk? Is it a bad sign? Is it a negative connotation on the future trajectory of the company? I have no idea. But I know for a fact that the company has brought, the private equity has brought the company public. That means it provides significant value to the company, and any exit by the private equity group will signify some loss in the value in terms of the connections, the relationships, and also deep insight into the industry itself from from the connections that the private equity group has. These are the risks that Adore Beauty faces. Let's face it, take a step back, think about it. High competition, low bargaining power, no dividend policy, low EBIT margin moving forward into the future. I think these four are fundamental, engaging the company's health or the potential that it can gain moving forward to in the industry to gain market share. It does not seem to me that it's a positive sign. High competition is going to take away the customers from Adore Beauty, providing more uncertainty for investors because Adore Beauty might not be able to hit the target, the revenue target by the brokers. It's not a good sign. So let's sum it up. We've talked positively about the competitive edge of the company, the growth trajectory of the company. Great story right there, seamless e-commerce experience. Sounds great, isn't it? But when we come down to the risk factor, it hits you hard. It hits investors really hard because, the fundamental thing that incentivizes shareholders to invest are not there for Adore Beauty. So clearly, my recommendation here is to stay away from the company. We've seen that the valuation shows that the company is undervalued, but you know what? The numbers are not the only thing that drives the valuation here. External risk factor has to come into play when you make a decision. Low EBIT margin, like I said, low EBIT margin, high competition, no pricing power at all. How does Adore Beauty, incentivize investors to come invest in their company? Nothing at all. So in conclusion, I'll say this, I have always loved their service, have been purchasing from their platform over the past few years. Loved it, always loved it. It's fast, cheap. Go People has been very fast. The shipping policy is the best. But I would steer clear. I would avoid investing in Adore Beauty because of the risk that it faces in the industry. And that's all for this presentation. Thank you very much for listening. I'll see you soon.